Absolutely. So, for those of you who don't know me, my name is Jeff Huge, and I am CIO of my own family office, JWH Investment Partners. I have been doing this for about 5 years as a family office. Prior to that, I worked on the street for 30 years, about 5 years on the buy side, running a global macro hedge fund with the late, great Steve Leuthold at the Leuthold Group. And prior to that, I worked at three of the largest investment banks on Wall Street. On the sell side, I was everything from a prop trader to institutional equity salesman who called on some of the greatest hedge fund legends in the planet. So I got to see how how the hot dogs were made, so to speak. Giving you my perspective on this is comes from a lot of experience and kind of on the ground sort of approach to building portfolios and looking at things from the top down. Before I jump into it, I just want to mention that a lot of the things I'll cover in this presentation, we drill down to a much more granular level in our newsletter. This is a public newsletter that's available on Substack. It's called Huge Insights, The Big Picture. We've been writing it for the past 30 plus months. You can find it at hugeinsights.substack.com. So if you're interested in our work, that's one way to follow us. We're also on Twitter at alpha_insights. And you can always find more information on our website, and that's jwhinvestment.com, where we publish an institutional strategy service called Alpha Insights. And so what we're going to jump into right now is just kind of how we look at the markets from the top down. We start with our economic cycle model, and this model is based on an over 100 years of quarterly data. When I was at the Leuthold Group, we did a lot of research on trying to find data series that were highly cyclical. And what we determined was that the Dow Jones Transportation Average had the longest data series, first of all, and was the most cyclical of all data series. And so what I've done is I've detrended 110, now 112 years of Dow Jones Transportation Average data from a quarterly perspective. And what you're really looking at here is the momentum of the economy. And this is a pretty good measure of how the economy has ebbed and flowed over the last century. And you can also see that there's a pretty observable sine wave that shows up. That sine wave measures about 34 years from low to low. And the interesting thing about 34 years is it's a Fibonacci number, so it's a natural cycle. And what we find right now is that this cycle topped in 2022, and we are now looking at a downward bias or a deceleration regime in global, or I should say US economic growth. And not to say it's going to crash, it's just on a deceleration regime. And that regime remains remains operative through 2039 based on the cycle's periodicity. So keep that in mind with everything else we're going to talk about here. The first point I really want to make with respect to where we are in the economy is driven by our debt situation. It's really the elephant in the room. There's been a lot of research done on this. Most recently, we found research at the Aspen Institute that has really raised our eyebrows right now. You know, the debt to GDP in the US is now over 120%. And according to the research done by the Aspen Institute, it is expected to grow to about 180% by the year 2053. That's 3 decades from now. The interesting thing about that is that if we consider the research that was published by Reinhart and Rogoff back in May of 2010, they determined after looking at 200 years of history across 44 countries, both developed and emerging, that when debt to GDP ratios at the country level exceed 90%, the GDP multiplier effect of each additional dollar of debt actually goes negative. And it's interesting because the US is currently running a $1.7 trillion fiscal budget deficit over the last 12 months. And that's with full employment, no less. So this could potentially be a serious problem in the years ahead. The kind of evil twin to debt is the deficit. And also, according to the same research produced at the Aspen Institute, this fiscal budget deficit that we're running this year is about 6%. And the problem that they have without even considering a major recession or economic shortfall. They just think looking out three decades, we're going to be running deficits that reach around 10% of GDP. The biggest fundamental cause for that over the next 3 decades is that, based on current law, government spending to fund entitlements is expected to surge as a proportion of the U.S. population grows, above 65%, from about 17% today to about 22% by 2050. So that 5% increase, where a proportion of the population that is currently receiving entitlements, and believe me, people want to receive these entitlements. They have not planned for anything else. There is no plan B. For 90% of the population in the United States, they require these entitlements. And unless we want anarchy, they're going to get them. So a lot of this is putting pressure on inflation. And as we saw with the CPI data that came out today, it ran a little hotter than most experts expect. And what we're finding in our work is that core inflation remains much stickier than most people have estimated. This particular dashboard is published by the Atlanta Fed. It shows how the Federal Reserve looks at core inflation across a variety of different studies. These are 9 different studies created by 6 different Federal Reserve banks. They all measure core inflation from a different perspective. We all know that because Ben Bernanke once said that the core PCE is what the Fed focuses on, that's the only thing we should pay attention to. But the reality is, it's the only thing that they have time to talk about in the 30-minute conference presentations that they give after the FOMC meetings. If they had to talk about the influence of all 9 of these models, we'd be there all day. The bottom line is, these models all suggest that core inflation is running about 180 basis points above target. And that actually shows up with the core CPI today at 3.9%. And that was just flat. So I think what we're going to find is that most of these expectations of significant rate cuts in the first half of the year are probably not going to come to fruition. We think the Fed probably won't begin cutting rates until the back half of the year, if at all. And we think if it happens sooner, it'll likely be because we're in recession. So let's talk about recession and why it occurs. It's usually well known on Wall Street, when the Fed takes the punch bowl away, things start to go badly, right? Well, for some reason, that hasn't really happened to the extent to which it normally would be expected. We are in the most severe rate cycle that we've seen in 4 decades. Monetary policy has shifted from a 13-year period of aggressive accommodation prior to COVID to one that is now highly restrictive. And, the Fed really, having raised their funds rate 11 times over the past 22 months by 525 basis points, has put us in a situation where, we've got a very restrictive monetary policy, and it isn't really putting the kibosh on employment, wage growth, and inflation across the across the board. And so the issue that I think the Fed faces is whether or not they should cut. If in fact we continue to see inflation run 180 basis points above target, then the economy's running hotter than they want it to. And therefore, it probably is unnecessary to cut. If we look back 15 years, a 5% Fed funds rate was normal. So for the last 15 years, we've been living in this kind of anomalistic environment. And, I think the street has now pushed out the first cut from the March 20th meeting to the May 1st meeting. I think there's about a 51% probability priced in the market at this point. But I suspect that's going to be pushed out even further to June or July, and possibly even the fall, unless we go into recession. And there's a lot of evidence supporting that the economy is headed in just that direction. The M2 contraction that we've been monitoring for some time now signals a recession is on the horizon. Adding to the restrictive policy that we just discussed, the Fed's also been allowing their balance sheet to run off since April of 2022 at a rate of about $95 billion a month in treasuries. and another, several odd billion, I think another 35 billion in mortgage-backed securities. But this is a quantitative tightening function. And despite the $400 billion liquidity backstop that was created to arrest the banking crisis last March, they have since reduced the total size of their balance sheet by about 1.3 trillion through yesterday, down from a peak of around 9 trillion at its crescendo. And what we've seen as a result is real M2 money stock in the U.S. has been declining at a pretty rapid rate through month-end December, and this data is reported about 30 days in arrears. We've been declining at a rate of about negative 5.4% year over year. That is an improvement off the recent lows of about 9% or so, but it still ranks worse than any other prior decline prior to 1980. And the most recent discussions at the Fed have been focused on when to end QT. They're wrestling with a bit of a battle right now because, as some of you will know, the reverse repo facility has been drawn down from about 2.2 trillion last May to just about half a trillion right now. And in order to maintain ample reserves for the banking system, if we continue to see that drawdown in the reverse repo facility to zero, they will have to end QT in order to maintain enough reserves and liquidity for the banking system. According to research published by the Brookings Institute, that's most likely to occur around the first quarter of 2025. So we'll see about that. The second issue out there is that bank lending is signaling a recession. Another model that we follow pretty closely is the growth rate of commercial and industrial lending. And, as we've seen in the widely discussed, SLOOS report, we still have bankers out there that do see a tightening of lending conditions. But, I think this decline in commercial and industrial loan growth, which, contracted for the second consecutive month in January at a rate of negative 1.6% year over year, that's never happened before in the history of this data going back to 1960 without being attended by a concomitant U.S. economic recession. So this credit crunch that everybody has been anticipating appears to have arrived and appears to be in full swing. And the issue here from our perspective is this. We continue to see money flowing from the banking system, seeking higher yielding instruments such as short-term money market accounts that are paying over 5%, T-bills that are paying 5.4%. And these securities offer safety, liquidity, and an incredible yield advantage over what banks are paying. Banks have attempted to stem the tide by offering competitive yields in their jumbo CDs, but depositors continue to walk. And to be sure, this decline in funding sources and riskier collateral that Marty alluded to in say, office commercial real estate, that is tightening lending standards. But, as borrowing rates have moved up, that has curtailed new loan demand as well. And so this is happening from both sides. It's not just banks not having the desire to lend or the funding to lend. It's borrowers not needing or wanting to borrow. And this condition is ominous going forward. Another model that we follow closely is the Leading Economic Indicators Index. And that has been signaling a recession for some time now. Historically, we've never seen the LEI index negative for as long as it has been. The December reading most recently was down another 0.5%, another 0.1%. And that's a little less than what we saw in November, which was down 0.5%. But the LEI is down about 2.9% over the last 6 months. And it's been a slight improvement over the prior 6-month period, but it's still negative nevertheless. And we're below kind of this threshold of minus 4.4% that has historically coincided with past recessions. And we've been below that level for almost 20 months now, since August of 2022. And in most situations, we would find the economy in recession by this time. The conference board, who produces this index, now expects the US GDP growth to turn negative in the second quarter of this year and probably maintain that negative posture through the third quarter, but then begin to recover late in 2024, perhaps late in the fourth quarter. So we'll see how this plays out. But again, another warning signal of recession. A fourth warning signal that we follow is the yield curve. The yield curve's been inverted for over a year now. That inversion actually bottomed last April, and it was the worst that we had seen in over 40 years. The inversion between the twos and tens is actually steepened quite a bit to just minus 0.31 or 31 basis points negative. That's down from a peak inversion of negative 108 basis points. The Fed claims to pay more attention to the 10-year 3-month yield spread. That was much worse. It was inverted by 215 basis points last April. That's recovered to just 127 basis points. Usually these inversions can last anywhere from around, say, 10 to 33 months. They have tended to precede each and every recession over the past 50 years. And I don't think that there's any reason why we should expect it to change now. It's been a shot across the bow, typically. It's when we see this inversion begin to re-steepen and uninvert that we know the torpedoes are in the water and recession is imminent. And I think that day is coming very quickly based on these 4 models. The 5th model we follow is unemployment. And the question we have, it's the only of our 5 models that hasn't triggered a recession warning signal yet. Now, this is based on the SOM rule. SOM rule was developed by Claudia Sahm. She's a former Federal Reserve and Council of Economic Advisors economist. She's been featured on some of the financial media stations recently because of this work. The work basically says that when the 3-month moving average of the unemployment rate moves up 50 basis points from its low over a 12-month period, it has historically signaled every single recession back to 1960, and it's typically fired its signal 2 months into the recession. So there have been some parties out there that believe that the economy is much, much weaker than the headline data would suggest. And as a result, it may be possible that when we do get a signal here, and we think it's highly probable that signal will come in the months ahead, that we'll find that the NBER backdates the recession to sometime in late 2023 or early 2024. So to be determined. So if we're heading toward recession, I think the number one concern we need to have is what the impact to earnings is. Earnings have historically experienced significant drawdowns in every past recession. There have been 10 recessions since 1957. According to research published by D.A. Davidson, looking back at those periods, the average EPS drawdown during recessionary periods has been a little less than 30%. If you kick out the 2 worst instances, which was the tech wreck in 2001 and the great financial crisis in 2008, take the average of the other 8, it gets to a little less than 19%. Our assumption is if we go into recession, we'll see earnings decline by around half the average or around 15%. And if that were to occur, earnings for 2024 could come in something closer to $187 versus where the consensus is today at $240. And if the odds are indeed shifting toward a recession in 2024, and we think they are, then valuations are going to begin to matter quite a bit in the not too distant future. The problem is we have some of the highest valuations on record right now in the S&P 500. It is largely skewed up by technology and communications and to some extent discretionary. But if we add all of those sectors together, their weighting is over 50% of the S&P 500's market cap. So it's very, very significant. In fact, some specific data that we've done, we found that the top 100 stocks in the S&P 500 are currently priced at 27 times 2024 estimates. These are S&P operating estimates for each of these companies, bottom-up estimates. And that's actually 70% of the market cap of the index. So I don't think that the current valuations of the S&P really reflect what's happening inside. I think it's actually worse than people think. And if we take a look at some more traditional valuation metrics like market cap to GDP, Warren Buffett's favorite, we're at about 180%. That's below the peak of around 210, but it's well above the prior secular peak of 142%, which was recorded back in March of 2000. If we look at a inflation adjusted normalized margin basis of the S&P 500, the way Shiller has done in the Shiller CAPE ratio, we're trading at 33.6 times. It's down from the all-time record high of 44 back during the dot-com bubble, but well above the average of the last 120 years, which has been 17.3. Look at dividend yield, 1.41%. That's plumbing its historical lows. Price to sales, 2.7 times, down from the all-time high of 3 that was achieved last year, actually, or in 2022 rather, but well above the March 2000 extreme of 2.1. So from a sales perspective, the S&P is valued higher than it was at the dot-com bubble peak. And then of course on price to book, we're at about 4.7. The all-time record high back in 2000 was 5, so we're just below that. To say the least, it does not appear to us that the market is pricing in an imminent recession this year. So before we jump into kind of our market outlook,
just a quick question, Jeff. Any questions here in the audience? Okay, hold on a second.
I'd like to ask a question, but I'd like to ask this question from policy perspective. If a change in administration occurs, what do you anticipate those policies and how would that correlate to what you're talking about now? And if it stays the same, what are your thoughts on moving forward compared to what you're talking about?
Jeff, I'm going to ask you to table that for now. I want to address that later. Any other questions that are more macroeconomic at this point in terms of measurement? So Jeff, just so is it proper to ask that maybe the valuations that price earnings ratios that we see are more valid when there were lower interest rates, and maybe the ratios that we're seeing now are just kind of a hopes that there's going to be a cut?
Well, there's something called the rule of 20 you may have heard of, right? And that's basically that the market is fairly valued when it trades at a PE multiple that equals 20 minus the inflation rate. Well, we just saw core inflation is 3.9. So 20 minus 4 is 16. If we just look at forward 12-month valuations on the S&P, according to FactSet, they just exceeded 20 times. But that has a lot of really low valued stocks that are kind of also rans, the bottom 100, if you will. The top 100, which is 70% of the market cap of the index, trade at 27 times on average. And so I think that the market is hugely overvalued. I think that if rates even were to go to zero, we're just at fair value based on zero. So, I would say that the market's pricing in, a severe recession. They're hiding out in the highest market cap, highest quality, best balance sheets. That's what it seems like is happening here. And those earnings are at risk too.
Something that's really interesting, Jeff, is that, and you brought up already the Magnificent Seven, those, 7 top tech stocks.
We call them the Sensational Six now.
Sensational Six, right? The ones that are really showing all the growth, but the reality is they don't create lots of jobs, right? I mean, Hewlett Packard, Apple Computer, those companies back in the past created lots of jobs for
they're cutting jobs at a rate of tens of thousands. Microsoft cut 16,000 jobs last year, Apple over 1,000, Google 10,000 jobs twice last year. Amazon's hired 100,000, then fired 50,000, and they're still cutting tens of thousands. Because they're automating all their distribution.
That most of Amazon's jobs they're not they're not head of household jobs either, right? So
no, they're second jobs or part-time jobs. They're minimum wage jobs.
right, right.
Here's the thing, Marty. I think that again, the stock market has been held hostage by this, addiction to policy support of low interest rates and added liquidity. And every time, it looks like something's going to go wrong, the Fed jumps in and they cut rates or they pump up a bunch of liquidity, and everybody says, well, the fix is in. I got to get in and own risk assets because they're just going to bid them up.
Sure.
And that at some point can't sustain. It can't go on forever.
Sure. I mean, well, we see that the impact is this over financialization has led to things like, poor housing development and things like that. So, any other questions that are economic oriented? Because we're going to get to the political in 5 or 10 minutes. Rich, you want
to? You probably know about this. You want to comment? I think Bloomberg has an article that the Fed is flying blind in the sense that the Fed is following job openings. And now, since people are working remote, if a corporation wants to fill one job, they're posting it in various cities. And the Fed's seeing, 10 job openings for every actual job opening. And I know, for example, Goldman has job openings and they don't fill them, right? You know this point. I think this kind of underscores your thesis, but do you want to expand on that?
Well, I'll just say this. I've looked at some of these job openings just to kind of get a sense of what they're all about. And the qualifications for the average white collar job are so extreme, no one qualifies for them. I mean, no one meets the minimum requirements. I mean, I couldn't get hired by any Fortune 500 company, and I'm highly educated and highly experienced, and I probably just have too many gray hairs on my head, and they wouldn't want me anyways. But I think what most of these job openings are fake. They're not real jobs. If we could find a guy with a PhD and 10 years experience in AI programming, we would hire him on the spot. But there just aren't any guys that fit that description. You know what I'm saying? So that's what I think is really going on out there.
Yeah, I'm sure a lot of jobs are published also for immigration purposes. So that's probably a sticky subject.
So Marty, let me just say this. A lot of people have been really focused on, the extreme moves that we've seen in this bull market year to date. Even some companies like NVIDIA are up 45%, Meta up 40%. These two stocks are really dominating the performance of the major indexes, with the NASDAQ 100 up, some 6.5%, the S&P up 5.5%. But the average stock, if you look at the S&P equal weight index, it's up less than 1% year to date. And if we look at the last 2 years, since the market's peak in the S&P equal weight index, which was actually in November of 2021, it's negative. So, just 4 stocks account for over half of the S&P 500's year-to-date return. And you can see pockets of severe weakness. I mean, obviously, regional banks are getting killed again. They were the worst performing industry last year. They're down another 9% year-to-date. And there's been a lot of Fed...
right here. New York Community Bank is crashing, right?
Exactly. In fact, I was just going to mention it. New York Community Bank stocks down 60% in 5 days over the last week after they unexpectedly had to write down $185 million on 2, CRE properties. One was an office property in New York City. And so at the end of the day, I think, we've got a developing banking crisis on the horizon. And I think the street has sniffed it out. And even the Fed chairman's acknowledged it, but he says it's manageable, and that remains to be seen. I think the chickens are on their way home to roost at this point, and we've got to be cautious. You could have done just as well in T-bills as you would in the average stock year to date, and over the last 2 years, you would have been way ahead if you owned T-bills, and so and you would have avoided a lot of aggravation. It's only those top 7 stocks, or more recently 6. And if you really want to drill down, 4, the fabulous 4, NVIDIA, Meta, Amazon, and Microsoft. And Microsoft's barely in that group. It's really 2 stocks that are driving everything today.
Sure.
If we take a look at...
I want to just jump in here because in my opinion, I think that we actually have been in a rolling recession since COVID, but the Fed has been able to orchestrate things so that there's been demand in certain areas, but, pockets have had incredible suffering, and healthcare is hitting a brick wall right now.
I concur. I think you hit the nail on the head. It's shown up in housing and real estate, manufacturing. We started out with a severe recession in hospitality, and that's reversed, and everybody shifted from purchasing goods to purchasing services again, right? And so you can hardly find an open table at your favorite restaurant on a Friday night. But if you talk to any restaurateurs, those tables are empty from Monday through Thursday. And so, everybody's cramming in on the weekend, working for the weekend, if you will. And a lot of restaurants are shutting down, at least in the Midwest. You can't even go out to dinner on a Monday night or a Tuesday night. No restaurants are open. That's the way that they're managing it.
Yep. Well, I mean, there's actually a lot of restaurant business in New York this week because of Valentine's Day. So, I know you've got a lot of stuff to present, and maybe we've got like 5 or 10 minutes left, but can you talk about energy? Because it seems like energy prices are going back up, and I think that's a pretty big component of inflation. Just give it a minute.
Let me say yes. I think there is a supply problem right now, and I think that's a Middle East supply problem. They're shutting down production. I think yesterday there was an article in the Financial Times discussing how Saudi Arabia has basically put the kibosh on expanding their capacity. And I think that's going to be a problem throughout OPEC. And the U.S. has spare capacity, but they can't just flip the switch. It's going to take years to develop. An interview with the chairman of the board of Chevron indicated that he thought that they could increase capacity by 1 to 3% over the next 24 months. So it's not a ton.
We've relaxed a lot of our trade with Venezuela so we can import Venezuelan oil, and it's gone into the markets as well. But meanwhile, Venezuela has amassed this huge army on the border of Guyana, is it?
Yeah, Guyana, right.
There's a conflict over...
They want the oil.
Oil, right? This huge oil reserve they found in Guyana. So we are talking geopolitical, I guess. But why don't you give us a couple more slides, and then we'll get into geopolitics, and we can answer Steve's
sure.
question.
Let's talk sentiment right now. Market sentiment is diverging bearishly. So we look at two versions. We look at the National Association of Active Investment Managers, which is the PROS, and this is a weekly survey of professional asset allocators, CIOs at many RIAs and hedge funds, and guys that can make asset allocation changes to their equity exposure. And we saw it peak in late December up here around 102%, exceeding the July high of 101%. That's a leveraged position. We then saw it roll off as things were a little soft after the first of the year, but we've rallied back to a lower high, even though the S&P has pushed to much higher all-time highs in price. That negative divergence tends to be a bearish signal. It shows that, while everybody's still all in on the bull market, you're seeing this element of doubt begin to surface. It's showing up here in the AAII individual investor survey as well. We got to 32%, 2 consecutive weeks in a row between the bull bear spread. That's the highest we've seen in 3 years, and far exceeded what we saw back in July before an 11% correction. We again saw that pullback in the early part of the year as things softened up, but the rally back has just gotten us over 25%. We're about 26.4. Again, another bearish divergence. This is a negative. It indicates that there is some doubt beginning to surface. Our analysis of the stock market is based on something known as the Elliott Wave principle. And just to give you kind of a short synopsis of what that is, it's an interdisciplinary framework developed by a guy named Ralph Nelson Elliott back in early 1930s. It utilizes concepts from the fields of behavioral economics, mathematics, fractal geometry, and it's used to identify self-similar patterns in the prices of most publicly traded securities and broad market indexes in order to make probabilistic judgments about the current and future path of prices. Elliott had this view that there are 2 wave modes. There's a motive wave, that's the direction of the market's long-term trend, and then there's a corrective wave. And the motive wave is defined by 5 waves, and it's labeled 1, 2, 3, 4, 5. And so there's one wave up, which is also a motive wave that subdivides into 5 and so forth. Each one of these would subdivide into 5. And each motive wave is bifurcated by a corrective wave, which is labeled with an ABC, and that's a 3-wave pattern. And so you count this up, 1, 2, 3, 4, 5, at a very, very large degree of trend, and correct it in an ABC 3 waves. And that happens whether you're talking about a 100-year trend, a 10-year trend, a 1-year trend, or a 30-day trend. The pattern is the same. It is a repetitive fractal, okay? So with that said, let's take a look at how we look at the long-term structural perspective of the market. This is a 100-year quarterly view of the S&P 500. And what we're basically saying is that if we use Elliott's principle, back in 1929, we saw what we would label today as supercycle wave 1. And by 1932, we got to supercycle wave 2. From 1932 until today, actually yesterday, we put in what I would describe as supercycle wave 3, a 5-wave pattern at cycle degree 1, 2, 3, 4, 5. And that 3rd wave subdivided into a very visible 1, 2, 3, 4, 5. And so what we need to do is we need to correct this supercycle wave 3 the same way we corrected this cycle wave 3 with an ABC. And so we anticipate a very large degree supercycle ABC pattern that we think will carry prices back down to the long-term trend, which basically connects the 1932 and the 1937 lows. Now, if that's too extreme, it's possible that it might only carry back to this secondary trend line, which connects kind of the 1952 and the 1974 lows, and then also the 2009 low almost connected to that level. And we could get back there, and that might contain it. And that would also, be above the prior highs that occurred in 2000 and 2007. A lot of people like that idea much better than what I'm proposing here. But at the end of the day, if we correct at supercycle degree the same proportion as we did back from 1929 to 1932, which was a 78.6% retracement, a Fibonacci retracement, that will carry us pretty much back to around 1,200 on the S&P 500. And we think that could take a decade or so for it to completely play out. Might even take longer than a decade. So what I'm showing you here.
Yep.
Go ahead.
So we have probably less than 5 minutes. So I just want to get it back into Q&A, and because I do want to address the political situation.
Yeah, so I have a comment to make on the political situation, but I'm going to jump ahead here over a 60-second period and get you to where I want to be to jump into that, if you don't mind. So where we're looking at a 15-year view of the S&P, we think it's possible that we're peaking at 7 degrees of trend. We think something like minute degree, sub-minuet degree, minute degree, minor degree, intermediate degree, primary degree, cycle degree, and super cycle degree. And if we're right, we threw over this trend channel yesterday, and we think we'll come back below it to confirm that. And if we take a look at the 1-year daily perspective, we had a price target that we published of 5,032 for the S&P 500. We overshot that by 16 handles yesterday to 5,048, but closed below it at 5,046. Today we are crashing down some 68 handles, and we will probably take out this trend line here at around 48. I'm going to say, I'm sorry, 48.90, I think, is where that comes into play. And so we're at about 49.70 on the future. So we're less than 100 points away of taking out that trend line. We have extreme greed in terms of the investor perspective going into this. We've been diverging in terms of breadth, sentiment, and volume. It all looks like the market is peaking and rolling over, and we think it's going to be the early stages of a major correction. So we want to jump into political, and I have a slide on the 2024 election. I call it election disconnection. And one of the things that I think is happening out there is that you've got this early sort of convergence on these two candidates, Joe Biden and Donald Trump. Trump has very quickly cleared the field with all except Nikki Haley. I think she'll be out on November 24th when they complete the South Carolina primary. If she can't win in her own home state, then there's no chance. But I don't think she'll throw in the towel, because there's a real possibility that Trump, may not be the candidate because of his legal situation. We won't know that for certain. But I think that there's a more important consideration here. There's a possibility that Joe Biden won't be the 2024 presidential candidate for the Democrats. We've heard a lot of rumors in recent weeks that DFL party elites are laboriously searching for a replacement candidate. They have lost total confidence in Biden. His approval ratings now toward the lowest it's been in his entire presidency, sub 39% as of yesterday. And there's even been rumors that none other than Michelle Obama could be presented as the Democrats' candidate. And if news articles from the New York Post are to be believed, this could happen before Super Tuesday. And there are a lot of significant donors in the DFL that are favoring that. Now, Michelle Obama has been very vocal that she does not seek political office and never will. But Barack Obama has been out talking to major donors, trying to see if this is going to be palatable. And it seems like they're getting the nod. So we could find out before Super Tuesday that Joe Biden withdraws his candidacy and releases his delegates, and that Michelle Obama is ushered to the front of the room and coronated the candidate. That's one possibility. Something else that's happening out there is that, and we saw this during the Super Bowl, RFK is not, he's not taking rejection well, put it that way. He's relaunched his campaign as an independent, calling it the We the People movement. And he's got backing from the American Values Super PAC, which is loaded. They spent $7 million for a 30-second Super Bowl ad that promoted RFK as kind of the people's candidate, looking at the nostalgic Kennedy, administration and kind of comparing himself to another John F. Kennedy or Bobby Kennedy. And, I don't think he can win the presidency, but he might be able to win 37 electoral votes. And if he does, that would make it impossible for either other party candidate to win 270 electoral votes to become the president. And so that would put an end to the two-party system for the 7th time in U.S. history, and it would force a contingent election for the 4th time in U.S. history.
We're not going to be able to go out of time. Jeff, thanks so much. Great job. So I want to just do a quick survey before our next speaker. How many people here think that the nominee from the GOP party would be Donald Trump? How many people think that the nominee from the Democrat Party will be Joe Biden? Does anybody really think Michelle Obama is going to be the nominee? Do anybody think RFK is going to win any electoral votes? Come on, common sense. Not going to happen. Jeff, listen, I love you, but that's off.
Well, we won't know, will we? Until we'll know in the fullness of time. Let's put it that way.
I love the economics. If you can answer Gudrun Zeller's question on the chat, that would be great. And also, if you can answer Steve's question on the chat, that would be great also. But we're going to jump now to talking about fractionalized art, equity, and lending strategies. I don't have Alan, but I do have Eric. So Eric Ahrensberg's going to come up here. And Eric, you're a Wharton guy, right? Yeah, so another Wharton guy. So we're going to talk about and take your full 25 minutes. So we actually have some free time in the afternoon. We're going to roll into that on the schedule. Jeff, can you close down your share screen?